My name is Jen, and this is Lynette with me today. We're part of the community engagement team here at Horizon Credit Union. Thank you for joining us for today's pop-up on credit scores and reports. This is, everybody has been muted and cameras are off, so feel free to use the chat for any questions or comments that you may have. I put the participant guide link in the chat also, and if you would like to use that, please feel free to do so or just follow along. You do not need it to participate today. So credit can have a big impact on your life. Your credit report provides a snapshot of your financial habits that financial institutions, cell phone companies, credit card companies, and others use to get a sense of your credit worthiness. Understanding how credit scores and reports work will help you to keep your finances healthy and help you to achieve your financial goals, such as buying a home, purchasing a car, paying off debt. Click the raise hand button if you've ever checked your credit score. How about if you've ever requested a copy of your credit report? So before we get into why credit scores are important, let's discuss what they actually are. A credit score is a 3-digit rating that tells a lender how likely you are to repay your debt. Different lenders use different criteria to calculate it. Poor credit is typically less than 579. People with a score of 579 or below could probably use help to rebuild their credit history. Fair credit is between 580 and 670. In this range, it may be difficult to qualify for loans, and if you do get the loan, it may have a higher interest rate. Good credit is typically between 660 and 740. If your credit is between this range, you may have blemishes on your credit report, and you might still be restricted to some of those higher interest rates. A very good credit score is between 740 and 799. A credit score in this range is very good. You'll qualify for most loans, and you'll probably have a solid credit history with few missed or late payments. Exceptional credit is between 800 and 850. If your credit score is above 800, you have the strongest credit history and qualify for the best loan terms and interest rates. Remember, these credit score ratings are for informational purposes only, and later we'll learn how credit scores are calculated. Your credit score can be poor, fair, good, very good, or exceptional. But what if you don't have any credit history at all? Many people, especially young adults or people who have recently immigrated to this country, have no credit history. It's not really a bad thing. It's not the same as having bad or poor credit. Although people without credit history will face similar difficulties in getting loans and proving their credit worthiness. However, there are steps you can take to start building credit. First step is to open a line of credit. A good example would be a credit card through your credit union or a small loan that you can repay on time and in full. Special products such as secured loans are designed to help you boost your credit, but they may have restrictions on how much you can borrow or may require cash collateral. HZCU offers share secured loans to aid in building your credit history. Step 2, request that your payment history be reported to the credit bureaus. If you pay your rent and utilities on time, you can request that your landlord or utility company report your positive payment history to the credit bureaus. However, remember that your landlord or utility company is not required to do so, even if you ask them to. And step 3, this is optional, but you could open a joint account. You may request a family member or friend with good credit to co-sign on a loan or credit application. Just remember that your actions will also affect their credit, so make sure joint accounts are reported to the credit bureaus. Step 4, pay all your bills on time and in full. Never miss a payment. If you think you're about to miss a payment, contact the creditor and see if there are options available. So, how does your credit score affect your daily life and ability to achieve your financial goals? Let's take a look at a scenario. So meet Anna and Bella. This is a tale of 2 friends. Anna and Bella have been friends since middle school. They both own cars and have steady incomes to pay their bills. Anna's credit score is 530, while Bella's is 700. Anna and Bella both decide to buy homes in their childhood neighborhood. One receives a loan without any trouble. Unfortunately, the other has a difficult time getting the loan. And when she finally does get her loan approved, her interest rate and her insurance premiums are higher than that of her friends. So credit scores aren't the only factor that lenders consider. Factors such as market, down payment amounts, loan terms, and lender loan policies can also influence the cost of a loan. Still, experts and research show that one's credit score has a large effect on the cost of a loan. So now that you know Anna and Bella's story, let's see if we can figure out a few details. I'll launch a quick poll here. It has a couple of questions in it, so feel free to answer both of those. First one is, who is more likely to have trouble getting a loan, Anna or Bella? And then number two, whose interest in insurance is likely to be higher, Anna or Bella? I'll give you a tip here. Those are going to be the same answer. So if you get one, you get the other. It looks like 100% Anna, which is correct for Anna. Let's get that poll closed here. So Anna's insurance and interest rates would be higher because of her poor credit. It's also likely that Anna could face other additional fees because of that credit. So as you've seen, credit scores can affect your ability to get a loan as well as your interest and insurance rates. They can also affect your eligibility for a rental home even, as many homeowners and property managers check credit scores before renting a property to somebody. Your credit score can also have an impact on many areas of your life, including getting a car. Of course, they're going to check your credit score when you get a car loan, getting a job in some states and some companies, setting up utilities and phone service. So your credit score is taken into account for an auto loan. Obviously, like we said, if you buy a car, it can also be difficult to lease a car if you have poor credit even. So just really limits those options. In some cases, employers may also check job candidates' credit scores to learn more about people's reliability. With poor credit, it can be harder to set up an account with utility companies and internet and cell phone service providers, and they may require hefty deposits. Essentially, any persons or any organizations that you're seeking credit from may review your credit report to ensure that they're lending to a responsible borrower. So much depends on this 3-digit score. So who actually comes up with the credit scoring system? Can anybody name any of the companies that you've ever heard of in the credit scoring arena? Type them in the chat if so. There's 3 big ones. Give you another tip there. So there are many agencies that prepare credit scores and they use different models to calculate them. However, the most popular scoring models are FICO and VantageScore. There are 3 main credit bureaus in the United States: Experian, Equifax, and TransUnion. They, along with lenders, use their own version of the FICO or Vantage scoring models. So the bureaus keep track of your credit report, the bureaus keep track of your credit history separately. So it's a good idea to utilize each one. If there are large variations or discrepancies among the reports, you should get in touch with the bureaus to figure out why. Credit scores may also be different depending on the financial product that you're applying for. For example, mortgage applications may yield a different score for you than if you were applying for a credit card. So, how are credit scores calculated?
As mentioned earlier, different credit bureaus calculate your credit score in different ways. And while the bureaus do not disclose the exact methods or the formulas they use to calculate your score, we do not know the general factors that they consider. The most important factors that affect your credit score are your payment history and the amount of debt you owe. Let's take a closer look at these factors and other payments or others that make up your credit score. So your payment history. Of course, payment history primarily includes looking at whether or not you pay your bills on time. And then, do you always pay at least the minimum amount? If you do, then you're in good shape. If you make even one late payment, though, it will likely have a negative impact. That's why it's so important that you always pay your bills on time and pay at least the minimum amount that's due. Another factor is the amounts that are owed. The amount you owe depends on a few factors. Owing money doesn't necessarily mean you are at risk to lenders. The most critical thing is showing that you make regular on-time payments toward your debts. The important piece there is what the percentage of your available credit is. And typically people who are using less than 30% of their total available credit would be at a lower risk for a lender than people who are using 90% of their available credit. Simply put, maxing out your credit card can negatively impact your credit score. And then the length of your credit history. Credit history is affected by how long you've been managing your credit, The longer your credit history, the more information a lender has about your repayment habits and reliability. People with a short credit history, even if it's steady and good, may be at a disadvantage because lenders may consider them to be at a higher risk. So it's important to build and maintain good credit early. So new credit or credit that you've currently applied for accounts for a smaller part of your credit score. Each time you apply for a new credit, a lender runs a check on the credit score and it temporarily decreases your score. It signals that you might be using too much of your available credit. And there are limited exceptions, but this one is most often true. And then the types of credit, a smaller portion of your credit score depends on the type of credit you have. People with a mix of credit types like credit cards, an auto loan, and mortgage may have a slightly higher score than those with only one type. Credit scores are extremely complex, and your actions and everyday decisions can influence your finances. How about someone else's actions? Can they affect your credit score? Many people think co-signing on a loan is a helpful action to take, especially if the person is your child or your significant other, parent, or close friend. Similarly, many married couples or people in long-term relationships to decide to merge their finances. It's important to know how this decision may affect your credit score. Have you ever co-signed on a loan or asked someone to co-sign a loan for you? Have you ever signed a joint credit application with a spouse or a family member? Have you ever been added as an authorized user on someone else's credit card or added an authorized user to your own? Let's look at a few scenarios to see how co-signing, merging finances, and sharing lines of credit can affect your credit score. Anna's house is in foreclosure. She has taken some steps to improve her credit and is now eligible for a loan. Anna wants to use the loan to try to stop the foreclosure process, but she has a problem. She needs someone to co-sign. Should her best friend Bella co-sign on a loan with Anna? How will co-signing affect Bella's credit score? And will co-signing affect Bella's credit score? It won't necessarily impact Bella's credit score, but the loan will appear on her credit report. And when you co-sign for a loan, you are promising to repay a loan if the other person does not do so. If Anna pays off her loan on time, it could actually help improve both Anna's and Bella's credit scores. If she doesn't repay her loan or she misses payments, it will affect both of their credit scores negatively. So let's look at one scenario. Michael and Tamika are getting married in 2 weeks. They're thinking about merging their finances by opening a joint checking account and applying for a joint credit card. Tamika has a good credit score, but Michael does not. Should they sign up for joint credit? How will merging finances with Michael affect Tamika's ability to get a loan? Merely having a joint account doesn't affect a credit score unless an account becomes charged off or goes to collections. It will affect Tamika's credit score negatively if Michael doesn't pay his portion of their joint bills. It could affect their ability to borrow since she may be considered a higher risk when they see both scores. And then many couples choose to get joint accounts because they're convenient. It's important to remember that even if a couple merges their finances, they will still have their own individual credit scores. There's no such thing as a joint credit score. And then in this case, Michael's credit score may not negatively affect Tamika's credit score, but it could negatively affect her in other ways. They may receive a higher interest rate on a car or a house because lenders may evaluate both of their credit scores to calculate the risk of lending to them together. That's not always the case, as some lenders may only look at the highest score, the lowest score, or sometimes both. It's important to be aware that a partner's poor or bad score may affect the amount you pay in some cases. Applying for credit on your own or with someone else can impact your credit score. It's also in how one repays the debt that matters. Be mindful of your own credit score before making decisions to co-sign a loan or merge accounts with someone else. Their actions, like not paying back a loan, can damage your credit. Also, their credit score can affect the cost of financial products for both of you. Adding an authorized user to a credit card also a common way to share credit, but keep in mind that the primary cardholder is responsible for paying the bills. If you both use the card responsibly, it can increase both of your credit scores. However, adding an authorized user can be a risk for the primary cardholder and authorized user when the potential to impact both scores is negatively. So we've talked a lot about credit scores, but what about credit reports? Are they different? Your credit report is a snapshot of your credit profile, including your history every time you take a loan or apply for a credit card. Those actions will appear on your credit report. It's important to review your credit report regularly. Also, it's one of the best tools to build and maintain good credit. So the 3 nationwide credit reporting bureaus calculate your credit score based on the factors that affect it. Many people wrongly assume that checking their credit score or report will affect it negatively. This is not true. In fact, keeping an eye on your credit report can help you in many ways. It can help you detect fraud and maintain or work towards a better credit score. You can get one free credit report from each of the 3 credit bureaus per year online or by phone. And to get free annual credit reports, you can go to annual credit report at https://www.annualcreditreport.com, which is the only website that is federally authorized to give you your credit report for free. The Federal Trade Commission maintains it. You can also request your credit report for free via telephone at 1-877-322-8228. Because you can only request your Equifax, Experian, and TransUnion credit reports for free once a year, think about spacing out your requests to maintain an eye on your credit reports every 4 months. You are entitled to 1 extra free credit report under certain circumstances to verify the information. For example, if you have some fraud, if you review your credit report and notice inaccuracies as a result of fraud, also through denial of credit, if you have been denied a loan, credit, insurance, or employment, and if that denial was based on your credit report. Also for under unemployment, if you are unemployed but plan to look for a job within 60 days, or government programs, if you are on certain government programs, you can do that. But what about your credit score? Is that included in your free report? Credit scores, unlike your credit history, are not currently included in the free credit reports available. Excuse me. You can get your credit score by requesting it from various companies, including the different credit bureaus. They may change fees, and always be wary of free offers. So once you've requested and received your free credit report, how do you make sense of it?
Your credit report will contain 4 major sections. Review each section thoroughly for accuracy. Make note of any inaccuracies, unknown, or suspicious details. We'll cover disputing and correcting errors shortly. There are 4 major sections of a credit report. First off is the personal information section. This section contains your name, birth date, social security number, and address, as well as the name of your spouse and your employer. The public records section. This contains information about bankruptcies, judgments, and any delinquent or unpaid taxes. Credit accounts. This section contains information about your debts and whether you have been paying your bills and loans back on time, or if you've been missing payments and are at risk for delinquency. It can include information about both open and closed accounts. Credit inquiry section. This includes information about organizations, people, or agencies that have requested to verify your credit in the past 2 years. There is some information that won't be included, such as medical information, information about religion, race, or sex, or information about your checking or savings accounts. Information about any debit or prepaid cards won't be included. And private loans, if you've received those from benefactors, friends, or family, won't show up as well. Requesting and reviewing the information on your credit report is the first step toward maintaining and building healthy credit. But what are some important things to look for? Let's find out. It's important to review your credit report regularly to make sure the information is accurate and up to date. Your credit report contains information about your credit history and how well you manage your debt. It can also be affected by public records, such as bankruptcies, unpaid debts or bills, or how much of your available credit you're using. Most of these types of information can remain on your credit report for up to 7 years. Bankruptcies, however, can remain on your credit report for up to 10 years, and certain tax liens can remain on your credit report indefinitely if they're not paid off. Let's look at the following dates carefully when you look at your credit report. So first off, you want to check the date your account was opened. Remember, the length of your credit history accounts for a good part of your credit score, so make sure the opening or closing dates of accounts are all listed correctly. Up next, you'll want to check any dates of delinquencies. So review delinquent loans and check that the dates are accurate and less than 7 years old. Dates of public records. Any public records of legal activity should be erased from your credit score after 7 years. 10 years for bankruptcies, remember. Dates of credit requests. Whether anyone, a lender, financial institution, employer, or homeowner requests your credit report, your credit score may be affected. Check the dates to make sure they correspond with the events that took place in your life. If you notice any errors, you must dispute the errors with the credit bureaus. Some people choose to work with credit repair companies, but before you do, it's good to know your rights. Next, we'll move on to repairing your credit. Reviewing your credit reports thoroughly is a good practice. If you come across information that is incorrect or fraudulent, you can take action. The first step is knowing your rights. Credit repair companies will offer to fix your credit for a fee. However, know the Credit Repair Organizations Act prevents credit repair organizations from engaging in deceptive practices, such as false advertising, that can cause you harm. It requires these organizations to be transparent about what they can do for you. In other words, credit repair organizations may not overpromise, for example, to delete all bad credit, irrespective of whether it's a legitimate debt that you've accrued. Also, credit repair services cannot demand payment in advance. So they must put any contracts in writing, and they must offer consumers a contract cancellation option. Your rights as a consumer are protected. So what can you do if you have bad credit? Repairing your credit means that you'll have to take a hard look at your finances, bills, and spending habits. As you know, unpaid debt, tax liens, and judgments can negatively affect your credit score. So what can you do to repair your credit once it's already been damaged? First off, you'll want to contact the credit reporting bureaus and inform them of any errors or false entries. Include your credit report, list the items that are disputed, and clearly state your reasons for disputing the items. Include copies, not originals, of any documents that support your request for correction. Mail this request via certified mail and request a return receipt to ensure that it has been received. The credit reporting bureaus are obligated to respond to you, usually within 30 days. However, if they decide that your dispute is based on unfounded claims, they may not respond. So make sure you include all the supporting documentation in your request. Step 2, at the same time, contact the company that provided the information to the credit reporting bureaus and inform them of any errors. The company could be a credit card company, a financial institution, or any other that denied you service based on information contained in your credit report. Include the same information, copies only, and mail this request via certified mail as well. Preventing fraud and fixing incorrect information are important reasons for reviewing and checking your credit report. But what happens if you've experienced an unexpected life event, such as a bankruptcy or divorce? If you've been through a bankruptcy, foreclosure, or divorce, there are steps you can take to reestablish your credit. They're actually very similar to how you establish credit in the first place. First off, you'll want to monitor your credit report and your scores. Next up, you'll want to pay all your bills on time and regularly. Nothing builds credit faster than regular and consistent payments. Step 3, get credit counseling. Not-for-profit agencies such as GreenPath Financial Wellness, offered to Horizon members, advise people about money and debt management, help create financial plans, and offer workshops. Step 4, consider your financial product options. As discussed, getting a secured loan can build your credit. However, there may be trade-offs such as fees or minimum deposit amounts that you should understand and ask the credit union about before applying. Now, let's take a look at how you can identify potential scams from credit repair companies. Oh, let's return to Anna, our friend Anna. She's been unable to pay her mortgage and her house is in foreclosure. She's researched several credit repair companies. Let's see if we can help her recognize the good from the bad here. So the first company promises to remove bad credit information from Anna's report. All she has to do is pay an upfront fee. The company assures her that they can scrub all negative information from her report. So how many red flags did you catch there? Couple, right? The company that Anna found promised to remove all bad credit information from her report and required her to pay an upfront fee. Should she do that? Definitely not. Anna should definitely not trust the company's promise to remove all bad credit notes or their request for an upfront fee. So according to the Federal Credit Repair Organization Act, credit repair companies must successfully remove the credit inaccuracies from an individual's report and provide proof that the report has been changed before they can request payment for services. It can take up to 6 months for this. Anna should also be suspicious of the company or any company that promises or guarantees to remove all bad credit information. That's a huge red flag. Credit repair companies can only remove negative information that is inaccurate or a result of fraud, not legitimate negative information. The same company has also advised Anna not to contact the credit bureaus directly, as doing so could negatively affect their efforts. Should Anna listen to this company? No way, definitely not. Anna should not trust any company that recommends or advises against contacting the credit bureaus. It's another major red flag.
So to recap, there are many red flags you can spot in a credit repair scam. They include the following: requiring upfront fees for a credit repair service, promising to remove all negative credit information from a credit report, offering to scrub or alter legitimate credit information, and instructing you not to contact the credit bureaus directly. You are entitled to dispute errors for free, and it's your legal right to do so. Asking for a signature on blank paperwork. If an agency asks you to sign blank paperwork so it can act on your behalf, it's a scam. Never sign paperwork, especially legal paperwork, without reading it thoroughly, ideally with the help of a lawyer. Credit profile number scams promises a new credit identity by issuing a credit profile number or a credit privacy number that is similar to a social security number is a scam. Fake social security number scams: any agency that encourages you to use a fake social security number or apply for an employer identification number, an EIN number, for tax purposes is a scam. EINs are typically used by businesses, not individuals. And legitimate credit repair companies can help to remove incorrect or fraudulent information on your credit reports. Credit counseling agencies can also help you improve your credit. We'll look at that next. So if your credit report is poor, you may consider taking advantage of credit counseling services. Green Path Financial Wellness is a great example of a legitimate credit counseling company endorsed by the NFCC and offered to Horizon Credit Union members. These agencies may help you create a financial plan to decrease your debts. If you choose to use credit counseling agencies, look for agencies accredited with either the National Foundation for Credit Counseling or the Financial Coaching Association of America. Look for services such as better money management techniques, debt reduction strategies, and financial plan development, and get information about their services and possible fees before paying anything or providing private information. Before we move on, let's watch a fun, quick video with 7 tips you can use to boost your credit score.
All right, give me just a moment to switch our share here. We'll get our friend the credit squirrel up on screen. All right.
I can't hear any sound, oh, there we go.
Yes?
Credit Squirrel, hey, I need some help building my credit score.
Shh. Yes, of course. Come in.
Okay.
Right. Here are 7 ways to build and maintain good credit scores. Number 1, pay your bills on time. Don't hide them and don't pretend they don't exist. Pay your statement balance in full each month.
That's simple enough.
Number 2, part of your credit score is based on the length of your credit history. So if you're just starting out, open one credit card and use it for small, regular, manageable payments, like a cell phone bill or gas.
Okay, something I know I can pay off every month.
Indeed. 3, keep your credit utilization low. This means using only a small portion of your available credit.
I don't think I understand.
Example, if you have $1,000 of credit available and you're using almost all of it each month, it makes you look as though you rely heavily on that credit line. Keeping your utilization down to about 10% keeps your credit score in tip-top shape.
10% utilization. Got it.
4, don't open a large amount of credit cards in a short time. Lots of inquiries on your credit report within a short time frame makes your score drop. 5, to give your score an extra boost, have a variety of credit. A mix of credit cards, retail cards, utility bills, and installment loans keeps your score balanced.
Nice.
6, try not to carry a balance. Pay off your statement balance every month.
What if I can't afford to do that?
If you can't afford to pay something off in a month, you probably shouldn't be putting it on a credit card in the first place. A credit card shouldn't be treated like extra income. Budget wisely. Making only the minimum payments each month can get you in trouble very quickly with all the interest you have to pay.
Yikes.
And finally, number 7, monitor your credit. There are free sites that you can use to get a good estimate of your credit score, as well as paid services to access the exact scores.
That's really great. Thank you so much, Credit Squirrel. Once again, you've been incredibly helpful. Oh, I was just getting advice from the Credit Squirrel. He lives in this tree and, you know what? Never mind. Everybody can go away now.
All right. I love those videos. Our friend Jen and the credit squirrel.
I know, that's cute, a cute one.
Those are fun. We'll get our screen share back up here and resume that presentation.
So we covered a lot of things that could potentially affect your credit. The good news, just like we learned in the video, a few good habits and strategies around managing your credit and debt can go a long way toward helping keep your credit score high. Here are some basic strategies again. Use your available credit wisely. Use less than 30% of your available credit. Do not max your credit cards. The video says 10%, but that may not be realistic for some people. Pay your bills on time. Pay off your credit cards each month in full if possible. Doing so shows agencies that you are responsible and reduces your credit utilization. Pay your loans on time. Not only does defaulting on your debit cost you in fees, but it also quickly damages your score. And then do not apply for several new credit accounts in a short period of time. Make a plan to reduce your debt. Create and follow a monthly budget and periodically review your credit report for accuracy. Being mindful of your spending and monitoring your credit are good habits to develop when building and maintaining credit. So to summarize what we've learned, your credit score is something that can affect your entire financial life. So make sure to take good care of it. A good credit score can help you achieve more of your financial dreams. But if you have poor credit, don't be discouraged. Keep track of your credit reports on a regular basis and adopt responsible credit habits so your credit score can be as high as possible. It can be an uphill battle and may seem like it's taking a long time, but making changes now can have a big payoff later. Thank you for joining us for today's pop-up. Does anybody have any questions? Jen? Finally.
Oh, I don't see anything in the chat, but if anybody does, please feel free to pop it in there.
Okay. Financially continue your financial journey at the Financial Training Ground on HZCU.org. Explore a variety of topics, including interactive guides at the top links shown, or create a personalized financial education playlist from the bottom link. Thank you so much, everybody. Have a great day.
Thank you very much for joining us. Have a wonderful day, folks.